Yes, Morgan, good morning and good to see you. And looking forward to this interview here with Carnival to talk about what's happening. Josh Weinstein joins us. He is the CEO. This is his first interview since taking over from Arnold Donald. Josh, it's good to have you on the show. Welcome.
Thanks, Sarah. Nice to be here.
So let's start with the quarter because it was really strong. Smaller loss than expected, revenue growth, almost back to 2019 levels. What's driving that strength?
Well, you know, it's what you ended with. The revenue picture is incredibly strong for Carnival Corporation and all of our brands. Our first quarter performance showed our per diems up significantly over 2019, and we just came off of a record booking period, what's typically known as Wave in our cruise industry, and we set a record for Carnival Corporation, most bookings we've ever had.
So Wave is, as you say, seasonally strong, right, January through March. Is the strength continuing into March now and throughout the rest of the year?
Absolutely. You know, what we found was Wave for us started earlier than historical trends. Black Friday, Cyber Monday were off the charts. It did not stop during Wave period. It did not stop at February. As a matter of fact, the highest booking week we ever had in this Wave period was the very last week of February. And on top of that, the momentum has continued into March. So we're actually over 70% booked for the remainder of the year, Sarah, which is real good. And as part of that, we're generating more of our bookings for onboard spending up front as well. So it gives us very, very solid footing for 2023.
So if that's the case, Josh, why then the guidance that is seen as potentially overly cautious here and a much bigger loss than Wall Street was expecting? You saw the big jump in the shares on the big beat, and now they're under pressure a little bit on that outlook.
Well, you know, we've been pretty consistent. As a matter of fact, in December, when we were talking about our outlook for 2023, well, we didn't give our yield or our revenue guidance. We gave guidance on everything else. And what we had talked about was on an EBITDA basis, when you normalize for fuel and currency and you look at that per unit, we anticipated that we would make sequential improvement every single quarter over 2023. And as a matter of fact, in 2024, we would rival our 2019 levels, which is what we're comping to. And as a matter of fact, in the first quarter, where we said we were expecting 50% of that level, we hit 60%. We're anticipating 2/3 back in the second quarter and to indeed rival our levels by the time we get to the end of this year. You know, clearly I can't get in anybody else's head about what people are expecting. What I can tell you is we're happy with the results. Everybody is working very hard, and certainly the quicker we can get there, the better. As far as we're concerned, getting back to 2019 levels is a nice milestone, but it's a milestone on the way to much higher performance as we increase our demand generation and revenue capabilities.
So my question is, because it seems to be a profitability thing that the street is stuck on, why aren't you seeing higher margins on the back of higher pricing with this demand coming through? I feel like you haven't gotten the benefit as the hotels and the airlines have on being able to boost pricing to very high levels. Are you seeing that now? Why isn't that helping more?
Well, you know, like I said, we actually hit higher pricing in the first quarter, and we're anticipating and projecting higher pricing over the course of 2023. Now, since we are doing a 4-year comparison on the cost side, we're also comparing 4 years of inflation as we think about 2023 versus 2019. But I would tell you this. We are an incredible value to land-based alternatives. It's one of the frustrating things about the industry. Anywhere from 25 to 50% lower when you line us up against a land-based alternative. Now, I can tell you for Carnival Corporation and our portfolio of world-class brands, we find that unacceptable. We think that there is plenty of room to drive increased demand, higher revenue, and actually still be a value play against land-based alternatives, which, as we've seen in our business and for our corporation, serves us very well, even if there are recessionary times ahead.
That's what I was going to ask about the strength of the consumer and whether you're seeing any indication that the macro is slowing down, because you operate not just in the U.S., but in Europe, where some are wondering if they're feeling it harder right now, too.
Well, you know, it's fascinating. We've seen no sign of slowdown, and that goes with respect to the booking trends that we've seen, for our results, for our onboard spending levels, which, if you think about it, is the most real-time data point we can have about the health and the psyche of the consumer. And we are up double digits versus 2019. And that trend has continued since we restarted. On top of that, what we've found is our European brands, which have been trailing our more North American-centric brands, they've really been coming back strong, particularly over the last 3 months. They set a record for most bookings for their business as well. So as we've gotten through the winter, as we've gotten through some of the concerns about home heating and the volatility that's centered from events going on geopolitically, we've really seen our European brands make strong comebacks and starting to get back towards the levels that North America is.